You know, in the massive, high-stakes world of commercial real estate, there's really just one number that rules them all. It's a single metric that can give the green light to a billion-dollar skyscraper or completely kill the financing for a small apartment building. So today, we're going to pull back the curtain on what that number is and exactly why it holds so much power.
Yeah, I know. It sounds like a bold claim, but trust me, in an industry that's just swimming in complex jargon and spreadsheets that go on for days, there is one thing that every lender, every investor, every developer is totally obsessed with. It's the first thing they look at, and honestly, it's often the final word on whether a deal lives or dies.
So what is this magic number? And how on earth did it become the ultimate gatekeeper for financing pretty much everything, from sprawling shopping malls to those giant warehouses you see everywhere? Well, let's dive in. So the metric we're talking about is a ratio, and you can almost think of it as commercial real estate's own little golden ratio, the key to its financial health.
Okay, so it's called the Debt Service Coverage Ratio, or for short, DSCR. Now, I know that sounds a little technical, a little intimidating, but the idea behind it is actually incredibly simple. The best way to think of it is like a property's financial report card, and it's designed to answer one very basic question.
And that question is simply this: after you've paid all the regular bills, does this building actually make enough cash to cover its own mortgage payments? That's it. That's the whole thing. It is the ultimate test of whether a property can actually stand on its own 2 feet.
So how do we grade this quarter report? Well, the formula is surprisingly straightforward. It's really just made up of 2 key parts. First up, you've got what's called net operating income, or NOI. So this is all the money the property brings in, mostly from rent, and then you subtract all the costs of just running the place, things like taxes, insurance, maintenance. But here's the crucial part. This is all calculated before you pay the mortgage. It's the pure, unadulterated profit from just the building's day-to-day operations.
And the second piece of the puzzle is the annual debt service. Now that's just a fancy way of saying the total amount of mortgage payments you have to make over a full year. That includes both the principal and the interest, the whole shebang. So you just take the property's annual profit, that's the NOI, and you divide it by its annual mortgage bill, the debt service. And voila! That simple little calculation gives you the DSCR. So what does that number actually tell you? Well, let's say your DSCR comes out to be exactly 1.0x. That means your net operating income is identical to your debt payments. You have precisely enough money to pay the bank, but not a single penny is left over. You're just breaking even. And as you can probably guess, that makes lenders very, very nervous.
And that brings us to the 2 main characters in this entire drama: the lender, who's got the cash, and the borrower, who wants to buy the building. Now, they're both staring at the exact same number, but for completely different reasons.
And right here, you can see the natural tug-of-war in every single deal. For the lender, a high DSCR, say 1.25x, is a safety cushion. It means there's a 25% buffer of extra cash flow, so if rents dip a little, no big deal, they're still going to get paid. But for the borrower, that same 1.25x requirement means they might not be able to borrow as much as they want, which forces them to put more of their own cash into the deal. And that, of course, directly hits their potential return on investment.
So how does this actually play out in the real world? Well, lenders don't just pull a number out of a hat. The target DSCR they're going to demand changes, and it changes pretty dramatically, depending on the type of property and how risky they think it is.
Check this out. An apartment building, what they call multifamily, usually has a pretty low target DSCR, maybe 1.20x, because its income from hundreds of different tenants is seen as really stable. But a hotel, man, its revenue can swing wildly from one season to the next, so lender is going to need a much bigger safety cushion. They'll demand a DSCR of 1.40x, maybe even higher. At the end of the day, it's all about risk.
And this is exactly how DSCR dictates how much money a bank will actually lend you. A lender will literally work backwards. They'll start with your property's $1 million NOI, then they'll divide it by their required 1.25x DSCR. That gives them $800,000. And that number is the absolute maximum annual mortgage payment they think the property can safely handle. From there, based on interest rates, they calculate the maximum loan. The DSCR literally sets the ceiling on your deal.
Okay, so what if you're a borrower and your DSCR is just too low to get the loan you need? What do you do? Well, if you look back at that simple formula, there are really only 2 levers you can pull. On the one hand, you've got to find a way to increase the top number, your net operating income. That could mean raising rents, filling up empty units, or finding new ways to make money, like charging for parking. On the other hand, You can try to shrink the bottom number, your annual debt service. That might mean shopping around for a better interest rate or asking for a longer repayment period to lower your yearly payments. It's a simple dynamic, but a really powerful one.
Now, this isn't just some dusty old concept from a textbook. Understanding DSCR is absolutely 100% critical to making sense of the major headlines you're seeing in commercial real estate right now. I mean, this timeline really tells the whole story. Just a couple of years ago, interest rates were practically zero. Money was super cheap, and lenders were fine with lower DSCRs. But then, rates shot up. Lenders got spooked, they slammed on the brakes, and started demanding much higher cash cushions and way higher DSCRs, which basically made a whole lot of new deals impossible to finance.
And this has created this massive problem you might have heard of called the maturity wall. You have all these building owners who took out loans back in the easy money days, and now they have to refinance in today's much tougher world. Their old loan might have worked just fine at a 1.20x DSCR, but now the bank is demanding 1.35x, a number their property just can't hit without them writing a huge check. And this isn't some small issue. It's a potential crisis that's threatening a multi-trillion-dollar industry.
Which really brings us to the most important takeaway here. DSCR isn't just some piece of bank jargon. At its very core, it is the ultimate stress test. It tells you whether a real estate investment is actually sound and if it can truly pay its own way.
So the next time you read a headline about a huge property deal falling apart or about a looming real estate crisis, you'll know the secret. You'll know that behind all the noise, it probably all boiled down to one simple question. Could the property cover its payments? Because in the end, it almost always comes down to that one number.